What's going on, everyone? Dave Ashworth here, and this week I want to talk about a really important topic, and that is what is a balance sheet. I think there's a really big misconception in the business community that the balance sheet does not hold a ton of weight. Most people, when they want to look at the performance of their business, they go right to the income statement. They're going to see how much money it's making. And that's obviously really important, but there's a lot of really important information on the balance sheet as well. First thing I want to do is talk about a significant difference between the income statement and the balance sheet. So with the income statement, you're looking at activity over a period of time. So let's say we're looking from January 1 to December 31st, a calendar year. You're going to look at all the activity during that year. Let's say that we're looking at the balance sheet at 12/31. So we're just taking a snapshot of certain things, and we'll get into those things at that particular moment in time. We're not looking at activity over a period. So I think it's important to first understand that before we continue our discussion. So first, why is it called a balance sheet? So there's a very basic equation that goes into the balance sheet, and that is assets equal liabilities plus owner's equity. Now I want to dive into each of those three things and explain what they are. So an asset is anything that the business owns that has financial or economic value. And I think it's really important to understand that just because the asset is on the books doesn't mean that you have full control over it yet. So let's say that you buy a piece of equipment, but you take out a loan on that equipment. You're still going to list the full value of equipment, and then obviously you're going to offset it with a liability. But that just to push that point across, you can still put something at the full value as an asset on your balance sheet, but not fully control it. And some of the most common assets are things like cash, accounts receivable, fixed assets, those type of things. On to liabilities. Liabilities are things that you owe, debt that you owe to somebody, or future obligations. This could include things like account payable, note payable, maybe it's a mortgage, and these are things that are going to need to be paid back. Now, this could also include something that's a little interesting. If someone gives you an advance, right? Let's say you're going to do a job for them and they give you money up front. Technically, until you perform the job or perform the service, you owe that money back. So that is also considered a liability. And the last one is equity. So equity is essentially how much of the business you own. So if you sold all of your assets and paid all of your debts, that's how much you would have left. That's your equity. Now, keep in mind, the equity is not necessarily what your business is worth. Typically, you value the business as a multiple of sales, EBITDA, cash flow, or some other factor. So you don't want to just look at the equity for what the business is worth. But technically, like I said, if you sold all your assets and paid all your debt, that's how much money you would have left in the business. That's your equity. So I want to give you a couple things to be looking out for on your balance sheet that are really important. So one thing is comparing your current assets to your current liabilities. So current assets are things that you can essentially turn into cash within a very short period of time, and current liabilities are ones that will become due within a 12-month period. So something to look at is, do you have enough current assets to cover all your current liabilities? And that's really, really important. So let's say that all of a sudden all of your liabilities became due. Do you have enough cash or assets in the business to cover those? That's something that you should definitely be looking for. Another thing to look for and to keep an eye on is your accounts receivable and accounts payable. That is the money that people owe you and the money that you owe people. Now, it's really important to keep a really good track of this because you want to know who owes you money, right? Because they're not going to a lot of times come out and tell you, and you want to know who you owe money to. One thing that you can do here is look at your accounts receivable and see how quickly people pay you. If you're able to speed up that process by implementing different policies or different technology, then your cash flow is going to go up. On the opposite side, on your payables, if you can stretch out your payables a little bit, if it's due within 30 days, try to take some of that time the best you can, because that will also help your cash flow. So accounts receivable, account payable, very important to monitor and keep track of. So there are many other things that you can be looking for when you're looking at your balance sheet, but those are just a couple that I wanted to point out that are very important. So I'd be curious to hear from you as you're looking at your balance sheet in your business. What are some things that you're looking for? I hope this video was helpful. I hope that at a minimum that you start to understand how important it is to monitor your balance sheet and be looking at that on a consistent basis. Thanks for watching, and we'll catch you in the next one.